Gentlemen, today is February 23rd, 2026. I want to talk to you about an investment idea, which is the convexity of gold miners. Now, first things first, gold has been on a tear over the past 24 months in particular, perhaps because the artificial suppression of the precious metal has come to an end and we are seeing the real result of unhampered credit expansion. That said, gold currently trades at, 52.29, up about 2.3% today. What do we have? The 10-year Treasury trades at 4%. Fed funds at 3.6. Silver's up 4% to 88.15. Now, let's get into this idea. Obviously, as with all things, do your own research. This is just an idea. This is not investment advice. All right, we're going to head over to goldwire.io, where you can read this article, 6 gold miners with earnings outpacing in valuations. Now, this is just an idea, but it's to demonstrate that precious metals mining firms have tremendous convexity. That is, as the price of the precious metal goes up, we'll run through these names today, and you'll see that a lot of them are up in excess of the gold price. So gold is up 2.3%. We'll go down the list, and you'll see some of them are up in excess of 5%. That is because gold miners have a relatively fixed cost to dig metal out of the ground. They dig a bunch of dirt up, they filter the dirt, they get the gold. Simplified version, but that's the gist. And they have an all-in sustainable cost that is relatively, depends on the miner, but is relatively fixed. Call it $1,500 just for reference. Now, if you have a $3,000 gold price, which you had at the beginning of 2025, then you would say, okay, you're going to clear about $1,500 per ounce. But when you have a $5,000 gold price, suddenly your operating income explodes. And so we highlight that, interestingly, these are what I'm dubbing the new growth stocks. It used to be that technology was the large growth sector. And we'll do another video on this, but if you look at the S&P 500 earnings yield, you see that the S&P 500 trades at about an earnings yield of 3.6%, somewhere thereabouts, which is roughly akin to the 10-year Treasury rate. So really, there's no equity risk premium and there's no compensation for taking equity risk, except when you start to look at gold miners. One could argue that perhaps there was a watershed moment in 2025 when COMEX and other gold markets, the people started to request delivery, which meant that they had to actually deliver the physical metal, and perhaps now they're not able to as efficiently suppress the precious metals price. And therefore, we actually see the result of all of the inflation over the past couple of decades, which metastasizes in a markedly higher gold price. And along with the rising gold price, you get these companies whose revenue and operating income and net income are skyrocketing. And so we'll go down the list here, but you see we've got the name, we've got the ticker, and we've got the revenue growth rate for these companies, and then we have the forward PE ratio. So, for example, IAMGOLD Corp, IAG has gained 74.7% revenue growth over the past 12 months. AltynGold, Anglo Ashanti, Agnico Eagle Mines, Barrick Gold, DRDGOLD. The list goes on, but the gist is here that the revenue growth rates of these companies are 74%. AltynGold has grown revenue by 70% over the past 12 months. Anglo Ashanti, 61%. Agnico, 43%, etc. So they have double-digit growth rates in terms of revenue. This also translates into operating and net income just the same. And then you look at their forward PE ratios. IAMGOLD priced at 9.8 times forward earnings. AltynGold 7.2. AngloGold Ashanti 13.2. Agnico Eagle Mines 15.8 times forward earnings. Barrick Gold 13.1. DRD priced it 8 times forward earnings. So the gist here, and you can go read this article in depth. The gist here, and these are not specific, this is not investment advice, but this is just meant to demonstrate the point here that these gold miners with relatively fixed all-in mining costs are now the new growth stocks because their operating income offers convexity. That is, their operating income explodes, their profitability explodes with a higher underlying metals price. And so you see that their revenue growth rates are off the charts and they far exceed their forward PE ratios. Now, if you look at historical, their trailing 12-month, their current PE ratio, some of these are a little more expensive. But if you believe that we're going to have continued unhampered credit expansion and you expect that there's going to be a higher gold price, then these are something to pay attention to. The market has obviously been extremely hyped up about these names over the past 12 months. Their performance has already been spectacular. Apologies, I did not realize you can't see it on the screen. Their performance over the past 12 months has been spectacular, and that's not to say, past performance is not indicative of future returns. But as compared to some of these growth stocks, for example, your run-of-the-mill, your Googles, your Amazon, whomever. I don't want to disparage any tech stocks. But what I will say is those seem to be relatively fairly priced. They are priced in accordance with their growth rates, whereas you have these precious metals mining companies whose growth rates are now exploding with a higher underlying metals price, and their stock prices are still lagging. So let's take a look at the current gold price. Beautiful chart here. You see that we broke above this previous high. If you were paying attention and had gone into the market last night, again, today's Monday, February 23rd. But looking at this chart yesterday, you could see that this was breaking above this previous intermediate high, and the gold price is up 2.4% today. So one would expect that we're obviously, I say obviously, one would expect that we exceed this previous high of 5,000, what is it, 55.80? So ostensibly we're going quite a bit higher on the underlying gold price. And then let's go take a look at some of these names. So gold is up 2.4% today. You then go look at AngloGold Ashanti, ticker symbol AU, up 6% in the market today, up marginally in aftermarket hours. We're breaking out to, maybe I should move this. There we go. We're breaking out to new all-time highs on this name. Currently trades at $122, earnings per share of $5, up 122% year over year, with a current PE ratio of 22, forward PE of 14.4. And you can go down the list, do your research on these names, but you see that their revenue is growing significantly in most cases. Obviously, you see that revenue growth really takes off in the later years where gold in the past 12 months has really skyrocketed. And we'll go down the list of these names, but I just wanted to bring this to your attention because I don't think that this trade is yet played out. Some of these have had tremendous performance even over the past year. For example, AEM up 150%. Let's go look back at AU. Up 282%. So again, buying into, there's tremendous momentum here. There's probably a lot of institutional interest finally coming into the gold mining space, and I think that these companies are going to be, I'm hesitant to say no-brainer because you do your own research and be responsible for your own risk. But as far as other ideas, this is one of the rare instances in the market where you see revenue growth that exceeds the current and forward PE ratio. Generally speaking, when you can find a solid company with solid financials whose revenue growth and net income growth far exceeds its PE ratio, that's generally speaking a very, very good sign. We go on to DRDGOLD Limited, up 3.5% today, has a current PE ratio of 16, forward PE of 8, which demonstrates that perhaps its future earnings will be off the charts. Obviously not as significant of revenue growth, but still respectable, up 30% year over year, which is far in excess of its current PE ratio of 16. Fortuna Mining Corp, not on the list, but another gold mining name, up 8.7% today. Let's move on. AltynGold up 4.6%. This trades on the London Stock Exchange. Current PE ratio of 12.4, forward PE of 7. So when you look at the S&P 500, current PE ratio, a rough ballpark, is in excess of 25. Then, in fact, what is the current? Current PE ratio of 29. So I was off. But, and let's go S&P 500 earnings yield, 3.37. So here's why this trade is interesting, because when you look at the current PE ratio of 29, that's just astronomical. That's off the charts. And when you're buying stocks and you're paying to take risk, I mean, we can get into the argument as to it's disingenuous to call the 10-year treasury the risk-free rate. But when the risk-free rate, disingenuously speaking, when the risk-free rate offers you 4%, why would you go pay to earn 3.3%? It doesn't make a whole lot of sense. But then you go look at some of these other companies. For example, DRDGOLD. You go to statistics. Earnings yield of 6%. You look at some of these other companies, and their earnings yield is going to be slightly higher. This is 4.3%. Because they have a PE ratio of 22, but their forward PE is 14. We go look at, let's say, AltynGold. This is priced at 12 times earnings, 7 times forward earnings. Its current earnings yield is 8.4%. And when you get to a forward PE ratio of 7, then you're going to be at an earnings yield of whatever math on the spot is, but like roughly 12%, 14%. We look at Barrick Gold Mine, Barrick Mining Corp. Apologies. Currently trades at a PE ratio of 16, so relatively fairly priced, but not priced at 29 times earnings. Forward PE ratio of 13. And you see it's had revenue growth of 31% year over year. Finally, we move on to IAMGOLD Corp. Revenue growth of 74% over the trailing 12-month period. Currently has a PE ratio of 19, but a forward PE ratio of 10, which is a forward earnings yield of 10%. So, wanted to just bring this to your attention. Obviously, do your own research, be responsible for your own risk, but gold mining companies, if you believe that the monetary system is askew, if things are amiss, and you believe that we have structurally higher gold and silver prices, then although you can buy the underlying metal, you might take a look at the precious metals miners because they offer tremendous convexity. And if you believe that the gold price is going to stay at current levels, when you look at the chart, it seems like it's going a lot higher. But even if they sustained the current gold price of, call it 5,000, all of these companies have reported historically on a realized mining cost of roughly $3,200 per ounce. So their earnings, their financial statements are lagging the gold price. So I don't believe that this is fully priced in by the market yet, because on a trailing basis, you look at financial statements and while their performance is good, they're still reporting last year's financial statements are based on a $3,200 realized spot price. So operating income, net income, earnings, etc. will continue to grow, even if this gold price stays relatively flat at 5,000. So I'll leave it there. Everybody have a good day.